Welcome back. I'm Jeremy Szafron. If you've been watching the economy this year, you know that the real story hasn't been the stock market highs or the Fed speeches. It's been the data, or rather the breakdown of it. Now, we're living in what many people are calling the year of the asterisk. Think about it. We saw 818,000 jobs erased in a single revision. We've watched the establishment survey and the household survey tell two completely different stories. And we've seen inflation numbers that don't match what we see at the grocery store. And now the ultimate twist, we're finally getting the delayed September jobs report this Thursday, but for October, the White House has confirmed this morning that the unemployment rate likely won't be published. Now, the surveys simply weren't done due to that government shutdown. So after years of revisions and confusion, the Federal Reserve is what some say flying blind into December. But here's the thing. While the government is dark, the private markets are screaming. Jeffrey Gundlach, the bond king, didn't mince any words today with Bloomberg, rather. He called the $1.7 trillion private credit market, quote, garbage lending. He compared it directly to the subprime rot of 2006. And then at the same time, we just got this massive signal from Europe. The Financial Times report that UBS is in private talks to move its headquarters here to the United States. Why? To escape a $26 billion capital hit in Switzerland. Now, we're going to get into that. And the numbers don't lie. The Century Foundation reported that the past due utility balances from consumers have spiked nearly 10% year over year. Now, you can debate a jobs model. You cannot debate a missed electronic payment. The Fed might be missing data, but the market isn't. Joining us to break it all down this morning is Stephanie Pomboy. She's a founder of MacroMavens. Joining us now. Great to see you, Steph.
Yeah, thank you so much, Jeremy. Pleasure to be with you. And as you said, there's quite a lot to cover right now.
Yeah. Well, I mean, the government's back. And before we get into that, I want to start with this UBS story because, it feels bigger than a regulatory dispute. If one of Europe's largest banks is considering relocating to New York, that's a huge shift in capital flows. The FT, of course, Financial Times reported this morning, UBS chair's Colm Kelleher has been kind of in private discussions with Treasury Secretary Scott Bessent about moving the HQ here to avoid that $26 billion capital hit under Swiss rules. Now, the pessimist says we're importing someone else's risk, but let's flip that. If the global banks start fleeing Europe and planting their flag in New York, doesn't that create a massive structural bid for the U.S. dollar?
Well, you would certainly think so. I think that's a good case. But I can't help but be struck by the irony that the financial capital of the world, New York City, just elected a socialist mayor. And now is the time that the European banks decide to come stateside. There's something that just seems a little discordant about that. And sort of the contrarian in me wants to view that as a signal that we've reached, and I'm going to beat the drum on this old tired thesis of mine, we've reached the turning point in the primacy of paper over rock. And I am a hard asset girl and have been for a long time. So when UBS, a famous Swiss bank, decides that it's time to pull up stakes and move to New York, which is now turning socialist, it seems like maybe that we're past our prime as relates to the engineering of financial instruments in general.
Yeah, just a little bit concerning, that news, huh? You've tracked the dollar wrecking ball for years. If UBS relocates to the U.S. and the capital flows them, does that supercharge the dollar, though? And if the dollar rips, what happens to the emerging markets carrying trillions in dollar-denominated risk, in debt?
Yeah. I guess the question is really how much will it shift their dollar-denominated lending? It seems like a lot of that is already taking place already, and it's just more of a physical movement of plant and equipment, let's say, more so than the output they're producing. We know for years and years that one of the reasons that the dollar index, for example, has remained so strong in the face of its withering status as a share of global forex reserves, as central banks sort of diversify into alternative assets like gold especially, is that the DXY, the financial flows dollar, has been supported by all of the financial activities that are conducted in dollars right now, whether they be taking place in China or Switzerland or in New York City. So I'm not sure to what extent it's going to dramatically provide a new bid for the dollar. I think the stronger argument would be that if a lot of European banks came over here and moved their headquarters this way, you'd be looking at some increase in employment here domestically. But, to me, it's, I guess I'm going to call it a nothing burger at the risk of being quoted on this a few years from now. And looking like...
I hear you on that. Hey, go back to New York. I mean, it's interesting looking at this because obviously UBS isn't leaving Switzerland because New York suddenly became laissez-faire paradise, right? It's leaving Switzerland because historically the safest banking jurisdiction on the earth has kind of shifted politically as well, just like New York, and regulatorily in a way that most global banks simply just don't trust anymore. They've kind of moved left. The capital surcharge is punitive. The AT1 wipeout shredded the country's kind of safe haven brand. So with that irony, I mean, is New York still viewed as a predictable jurisdiction, or is that about to change?
Well, I guess we're going to find out. I moved from New York, so I bet my personal, I made my personal wager on that 5 years ago. But we'll see. New York is really such an icon, and it's emblematic really of the strength of the country. And that's why, it's particularly disconcerting to see this shift, and it seems extremely knee-jerk and probably unlikely to be long-lasting. That's the hope, at least. So we'll see. But I guess I'm hopeful that they will dabble their toe in this little experiment and quickly determine that they shouldn't continue, and we'll go back to a more pro-capitalist sort of ethos, which obviously would be great for the entire country. But we shall see. We're definitely at an inflection point. And I think part of this, and again, I hate to get back to sort of the big picture themes. I mentioned rock versus paper, but another one of them is just this, people refer to it as the K-shaped economy, where you've had, people who are involved in the financial markets or have significant assets tied in them, feel indestructible, while, as you noted in your excellent preamble, the lower end of the consumer segment is, behind on the utility bills. The subprime auto loans are record delinquent. We're starting to see mortgage delinquencies creep up. Student loan debt repayment is an issue. So, there's real stress at the bottom. And Wall Street has heretofore really been able to ignore that because of all of this, robust financial markets. But I think this New York mayor election is sort of a shot across the bow to Wall Street. Watch your P's and Q's, because they're coming for you.
Little irony, right? Little irony. Okay, let's pivot to credit, because obviously Gundlach didn't tiptoe there. He called the entire private credit boom, garbage lending. And he said the valuations are binary, 100 or 0. But let's kind of get to the mechanism. I mean, garbage credit can sit on the books indefinitely until you hit a refinancing wall. And it seems like we've got a pretty big one. I mean, Steph, in 2026, we face one of the largest corporate maturity walls in modern history. Hundreds of billions of debt needs to be rolled over at today's rates. If companies are as weak as Gundlach says, I mean, what happens when they try to refinance next year? Is that the real event risk?
Yeah, I think so. And we've been seeing it. It's not like this is just going to suddenly pop up out of nowhere. We are now on pace for the fastest, the largest corporate bankruptcy cycle since the 2015 corporate credit bust, which, unless you are following the markets, you might not be aware happened, but it was a vicious corporate credit bust. And then you get things like, you're perfectly dead on about going from being valued at par one day to 0 the next day. And that's what happened to Blackstone with this Renovo investment that they had, where they were marking it at 100 cents on the dollar as of September 30th. And then you turn the page on the calendar and suddenly it's bankrupt. So this is both the virtue and the curse of these opaque private credit markets, where you can mark things to whatever fantastic fantasy you have, But eventually someone has to come in, some distressed seller comes in and says, I'm pulling the ripcord, and you're marked at zero or, somewhere close to it. And so I couldn't agree with Gundlach more. And it's something I've been talking about for ages, because we've been staring down this barrel of massive corporate debt that has to roll. Just in the next 4 years, I think 2/3 of the high yield market rolls. I mean, that's a massive amount, 65 basically percent of everything that's junk rated has to refinance. And if what we've seen so far in terms of the efficacy of the Fed rate cuts continues, they're going to be refinancing that debt at rates that are still way above what they were prior. The Fed's cut rates, the Fed has cut the Fed funds rate, but nothing else has followed. So the relief that all these firms anticipated, and I like to say, they've doubled, tripled, and quadrupled down on this bet that once the Fed cut rates, they'd get relief and they'd be able to refinance all this paper. And so far, we're seeing that's not holding true. But for the better part of the last 3 years, since the Fed tightened rates in 2022, 23, they have just been doing the extend and pretend and adding more debt and extending out, their durations and issuing the payment in kind instead of paying interest and all of these gains so that they could just get from here to the rate cut. And now we got the rate cuts and we're no better for it. So I think we're really at a point, and I think Gundlach's right to beat the drum now and say, this is all really going to quickly deteriorate. And we're seeing it, it wasn't just Renovo, but First Brands, Tricolor, all of a sudden the one cockroach has turned to 4, 5, 6, every day there's another one out there.
Yeah, you're not wrong on that one. We keep hearing about it, and it's even in the mainstream headlines. And you're just talking about that surge in payments in kind loans, companies paying interest with more debt because they can't pay in cash. That looks less like risk taking and more like a slow motion Ponzi scheme. I mean, how long before lenders stop pretending that these zombies are alive and force liquidations? Are we months away? Is there quarters away?
You're asking the wrong person, Jeremy, because I said a long time ago, when the Fed started raising rates, I said there's no way the average corporation, which is levered more than it ever has been before, is going to be able to tolerate refinancing their paper at these new rates. I mean, Jim Grant is just a fabulous wordsmith, and he described this as the mischief that takes place around 0%. And we had this extended period of essentially 0% financing, free money for everyone. And the idea that Tricolor and First Brands were sort of the only ones that were getting a little, let's say, handsy with their financial accounting is just laughable. These we're going to discover that there was a lot of mischief around 0%, and we're just seeing the most pathetic examples of it exposed first. But I think it's going to move up the corporate, up the chain, let's say up the quality chain, and surprise people by how far it touches. I mean, when you get BlackRock, they're not some fly-by-night organization, majorly invested in this firm that goes from 100 cents on the dollar one day to zero the next. That kind of stuff, you don't need too many of those before people start to worry about, hey, what's going on with BlackRock, And
I wonder who is caught holding the bag, right? I mean, the Wall Street defense, the defense we hear from private credit managers is relax, our capital is locked, there can't be a run. But that cuts both ways. I mean, does locked up capital actually protect the system, or does it trap the rod inside the black box until it all hits at once?
Yeah, absolutely. And the thing that I really am most concerned about are the innocent Main Street victims. And those are the people whose unwittingly, they're unaware, but their pensions have been invested massively in all these alternative assets, of which the private credit space has been the hottest area to be over the last several years. So what will happen is that, and you're seeing it already with some of the endowments, for example, where the funds, the investments in these alternative asset managers aren't throwing off the income they anticipated. They're having to turn to the capital markets themselves to borrow to fill that void. So you saw like Stanford came out and borrowed because their investment, the pension fund, Stanford endowment wasn't getting the returns because all that alternative asset capital was locked down, as you said. So it creates its own problems. So there can be secondary and tertiary effects that, we won't be able to anticipate, but will suddenly appear on our headlines.
Yeah. I mean, Gundlach in that thing, he said he was, more cash stable. Right now, he's kind of more holding a lot more cash. And I want to connect the garbage debt to gold, because historically, when a credit bubble pops, we see a liquidity flush. Investors sell their gold just to kind of cover margin calls on their bad loans. Gold's down recently at around $4,000. Was that the flush? I mean, was it kind of the baby flush? Is there any panic here for you?
Well, what I had been looking at leading up to that was the interest in gold among retail investors. And the way I was tracking that was the total shares outstanding of all gold ETFs. What you saw was as gold made its march up to 3,500 and then to 4,000, that retail enthusiasm started to build. Heretofore, no one had been, everyone was chasing AI stocks. No one cared at all about gold. But once it broke some crucial price level thresholds, suddenly it became this sort of momentum darling. And what you've seen is that pop, once we broke 4,000, you had a huge surge in retail interest. And that has exactly round tripped. So everyone who got in at 4,000 has now exited. So I think you basically flushed out sort of the Johnny-come-latelys who didn't ever believe in the fundamental long-term story for gold, but were just chasing, the chart pattern, basically. And so I think the downside risk here is fairly limited. You got to come back to sort of the bigger picture thing. What's changed in the long-term case for gold, which has been this global dollar diversification and the prospect of that being accelerated by another round of currency debasing expansionary monetary policy. And here we are waiting for the Fed to cut rates again. And then, the president now has yet another slot that he can fill at the Federal Reserve Board next year with Bostic's retirement. So, we're kind of greasing the runway for another major shift in expansionary monetary policy. I've talked to you about this before, Jeremy, that I think forget about the Fed funds rate. It's all about the balance sheet. And I think gold is sniffing out that balance sheet is going to go from doing nothing to expanding very quickly.
Yeah, as you mentioned, I mean, the fundamentals haven't changed. And isn't that historically what happens before a major kind of gold run? Retail flinches at the volatility while the smart money uses every dip to build positions. I mean, the real story was that retail might have panicked out, but gold didn't even crack $3,800. I mean, it's been just incredibly stable. If you look at that chart, 50% over this year.
Yep. And the miners have actually, I was afraid to look the other day when gold was down $112 or whatever. I was like, I can't look. And it turned out they really held up very well. And the miners tend to lead the price of the bullion. So, I feel confident about the long-term case, and I try not to get too worked up about these squiggles, but I understand that's not as satisfying for people who are, just getting into it, who kind of sweat every dollar swing. But nothing has changed in terms of the foreign demand for gold, the supply demand imbalance, which I would note is probably dramatically more profound in silver. And we're seeing silver, move too. And then you saw, I guess it was China now really trying to make some moves to stockpile silver. So we're into the deep getting into this hard asset versus paper trade as relates to the real money buyers, the foreign central banks out there. And we'll see, how long it takes for the broader investment community to actually get on board. But right now, nobody really believes that story. It was just a brief momentum play, and they seem to be over it.
Yeah, let's talk about this, I won't call it fake data, but at least this data blackout that we're getting. I mean, Kevin Hassett confirmed this morning that there will be no unemployment rate for October. The data was strange long before the shutdown, though, right? I mean, you warned about the birth-death rate model, the BLS algorithm that guesses how many new businesses are created. Now, without surveys, they have to rely entirely, I guess, on that model. In a year where business bankruptcies are rising, isn't the model almost guaranteed to produce fake growth?
Exactly. And that's the problem at turning points. You always see the payroll numbers or the unemployment. Payroll's overstated, unemployment rate is understated because they interpolate the same amount of jobs created from expanding businesses that are no longer happening. They just string it forward at a time when, in fact, businesses are closing rather than opening more rapidly. So that's always been the problem. And I guess from that standpoint, I would argue that having no data was probably better than having bad data, So it also sort of has focused investor attention on things like Tricolor and First Brands, which had we been getting monthly payroll reports that were inflated and made everything look fabulous, people might have been like, yeah, that's not a big deal. But now you're starting to see a lot more attention paid to things like what's the credit signs of credit stress, and also much deeper scrutiny of corporate earnings reports, because that's ultimately, the government can manufacture whatever data it wants. A company's profits are a company's profits. Now, admittedly, the way they report them, with recurring, non-recurring write-offs and sometimes, but if you're a good analyst and you can go through all of that and parse out what's real from the one-time nonsense, you can come up with a pretty good picture. And what you see is that the averages, just like was the case for the consumer, the averages tell you nothing, because you got 7 companies that are earning a lot of money, and then you got everyone else who's just barely squeaking by. And in fact, you have a huge swath of companies that aren't making any money at all. Getting back to the zombie thing, you mentioned zombie companies, tying it back to the corporate credit cycle. In the Russell 3000 now, 1 out of every 5 companies can't service their debt with their income. They're not making enough money to even service their debt. So this is the state of corporate balance sheets, and it's being masked by the 7 or 10 companies out there that are doing great, that make it look like everything's fine. And that's exactly what we've seen for the economy, which is driven by the consumer, where again, that high end is doing great. They're absolutely bulletproof. And the low end, meanwhile, can barely scrape 2 pennies together. So, it's not for nothing that you get these consumer sentiment surveys that are worse than they were during COVID and the Great Recession. I mean, it's amazing to me that doesn't get more attention. When people's optimism about their income after inflation is the worst in history, that's a pretty strong signal that the average guy out there is just not feeling what you're seeing on your Bloomberg screen every day.
Yeah, well said. Let me layer in something that just hit this morning, too. There was this brand new report from the San Francisco Fed, working paper, and it looked at 150 years of tariff episodes and full historical record, and the conclusions were kind of surprising. I mean, tariff shocks have historically lowered inflation, raised unemployment, not the other way around. They found that mechanism isn't price pass-through. It's more confidence. Tariffs tighten that kind of financial conditions, pull demand out of the economy. Are we getting this tariff story completely backward? Because right now everyone's screaming that these tariffs will drive inflation higher. But if the historic data says it's cooling the economy, is that what's happening? We got it wrong.
Yeah. No, I mean, I don't want to pat myself on the back, but I've been saying this since the fears first came out, that, the presumption that tariffs are a tax on the consumer. That was the phrase everywhere. It's your tax on the consumer. It's only a tax on the consumer if the consumer is willing to pay that tax. They have an option whether to buy that good or not. And if the consumer says, I can barely pay for XYZ at its current price, I'm sure as hell not going to pay for it when you slap a 20% tariff on it. The producer of that good is going to figure out pretty quickly, they better figure out how to reduce costs on the back end to prevent losing their market share. And that's what we've seen. In fact, during Trump's first term, when he first did the tariffs on China, you saw that basically all of those tariffs were absorbed actually by the Chinese exporters. They didn't even make it to the U.S. companies, much less to the U.S. consumers. So this notion that was just said as if it were law, that this new wave of tariffs was going to be a tax on the consumer, just struck me as completely wrong on its face. And yeah, I mean, there's some areas where it's a discretionary item and, like a Birkin bag or whatever. The person who's paying $100,000 for a handbag isn't going to care if it's another 10 or 20 grand on top of that. It's just all about owning that bag. But the average person, who's trying to feed their kids or buy them some, modest Christmas presents isn't going to be able to do that. And we've seen that very clearly in the data.
Yeah. And I guess it's exactly why we're seeing the fastest corporate bankruptcy cycle in years. If businesses are swallowing tariff costs, swallowing these higher interest costs and slowing, this consumers, something has to break, right?
Yep. Well, and that really comes back to the whole thing. I focus almost myopically on what's happening with interest rates and the lack of response to the Fed's efforts to bring them lower. But it's not just the Fed's efforts. The Treasury, Scott Bessent, when he was out on the campaign trail with the president, sort of trying to make himself, in contention for his current post, was out there deriding Janet Yellen's program of financing our deficits with T-bills. Then he gets to the office and he realizes, geez, that's pretty much the only option I have now. How else am I going to finance these massive deficits without seeing a massive increase in debt service? So they've tried to coax the Fed and pressure them to bring long rates down, but there's only so much the Fed can do. They can cut the Fed funds rate and hope everything comes lower. And that hasn't happened. And that's forced Bessent to continue this short end financing. And also, I think, led the Fed in its latest announcement to do the Q and the QT in the manner that it's doing it. Their plan is to, as they run off all their mortgage book, they're going to stop running off the treasuries, but they're going to continue to run off MBS, and they'll take those proceeds and recycle them into treasury bills, not notes, not bonds, bills. And I think that's because, we're issuing at the front end and the Fed is going to absorb at the front end until further notice. And right now it looks like until further notice is indefinitely because long rates just refuse to go lower.
Yeah. So, what you're saying is they're in a position where they must provide liquidity, not to fight inflation, not to support growth, but just simply to prevent a failed auction.
Yeah, absolutely. Yeah. They're very concerned about it. In fact, I think they called I don't know if you'd call it an emergency meeting with some of the big Wall Street banks to discuss liquidity in the money market, So the Fed is clearly concerned about that. And I think that was what drove the program. But I will reiterate that I think it's just a matter of time before they go to broadly re-expanding the balance sheet. And at that point, they won't just be buying at the front end of the Treasury curve, but they'll start to step out into longer dated maturities in an effort to accomplish what rate cuts have failed to do, which is bring that entire complex lower in yield and hope that provides relief to mortgages, corporate credit, et cetera. And the jury will be very much out on that for a while.
Yeah, for a while. You're not kidding. Okay, well, obviously Wall Street debates the models. Main Street deals with these invoices. Let's talk about the Century Foundation report today that these past due utility balances are up nearly 10%. You can kind of massage a CPI report. You can't do that with this type of data. If Americans are defaulting on electricity in November, what does that say about the holiday shopping season? Are retailers heading straight into a buzzsaw?
Yeah, this is something that when we talk about how bad the data has been for a long time, a lot of people were poo-pooing the consumer confidence and sentiment numbers as just being partisan. There's no way consumers feel that bad because look, payroll employment's strong, this is strong, that's consumer spending strong, blah, blah, blah. And I kept saying, if they're doing so well, why are they delinquent on everything at the worst rate since the global financial crisis? It just didn't stand to reason. It would seem more likely to me that the measurement of unemployment was wrong than that the delinquencies were wrong. You're delinquent. You're not faking that. So that seemed like a legitimate cause for concern. And again, we look at these broad average statistics of consumer spending, and they're being held up by the top end of that K. But more importantly, the composition of the spending has been less than compelling. If you look at the share of it that goes to things like shelter and food and energy, the things you have no choice but to buy, they're at recession level shares of the total spending. We're almost up to half of the average household's income goes to those things. And that's on average. Forget about, at the lower end, obviously 100+% goes to that. So I think the issue then becomes, how do we, we've got the tax cuts really starting to impact next year with the change in withholdings and potential tax refunds and no tax on tips, and all of that will really start to take effect. Does that provide enough of a boost to offset the drag from these oppressively high interest rates and the still stubbornly elevated price level, inflation, price level, that the average consumer is facing? And, it remains to be seen. I think it's going to be a close contest. And I think the student loan debt resumption will also be a critical part of that, because that's a significant chunk of money. And it hits at a swath of that consumer segment that's a little higher up and is probably spending or has been spending beyond their means. So we will discover in its absence how big of a role the suspension of those payments had in boosting, in supporting not just spending, but the payment of other debts.
Yeah. I was going to ask you. Because we got tariffs, reshoring incentives, these tax packages, the big bill that you're talking about, energy credits, industrial policy, even some defense spending. It seems like the whole kitchen sink. But does any of that actually boost the economy next year? Is it too small to offset what you just were talking about? The rollover in credit and earnings.
Yeah, I guess the question is, what do rates do from here? Do they move higher? If we do start to see more of these cockroaches and you get into a situation where there's a real risk-off attitude that sends private borrowing costs up from where they are, forget about lower, but if you get credit card rates up, mortgage rates up, corporate borrowing costs up, then I think it's impossible for any of that stimulus to overwhelm it, because it's just such a huge drag on consumers and corporations. If we continue the status quo, which has been surprising to me, if you look at a chart of, junk yields or the 10-year yield, or you're looking at basically a horizontal line sideways for 3 years. You don't often see markets move like that. They just don't move. Rates don't just sideline like that. They tend to overshoot and then cause the correction that, drives them lower. And they're much more of kind of a, volatile, like an EKG. So this is a very unusual period. And I would describe it as almost too quiet, when you see something like that. But it'll break one way or the other. It's either going to break higher or lower. And if it breaks lower in yield, it will definitely provide some relief. But the question is, what's the catalyst for moving lower in yield? Is it because we're in recession? In which case, you're swapping one problem for another.
And on the stimulus trap, I guess we could call it that. President Trump's talking about these $2,000 tariff funded checks. If that money hits households, does it produce growth, or does it just kind of vanish instantly, catching up on these back owed bills? Is the stimulus trade dead on arrival because the debt hole seems too deep?
Yeah. Well, we did see that with the COVID stimulus checks, where the people who didn't need to use that money or had money left over after they paid their groceries and filled their gas tank used it shrewdly to pay down their credit card balances. So presumably that would go a long way toward that. I also, just as a footnote, would add that in theory, the Department of Education was supposed to start garnishing wages for student loans who were delinquent by September sometime. And as yet, I haven't seen any reporting that they're doing that. I think that was, they threatened to do it. And as yet, it doesn't appear like they're actually garnishing wages. And maybe that's because they understand that that would probably end up hurting them more than helping them. So they're kind of just letting it lie for now. And maybe in the idea that if they do send out these tariff checks, those student loan payments will resume, and those folks won't need to have their wages garnished to pay them. So I don't know, but there are a lot of moving parts. And as it stands right now, you've got this very disturbing, very high stress level of consumers at the bottom that's really being masked by the top. But increasingly, I think you're starting to see a little more jitters in the markets around how sustainable this is, primarily as it relates to these issues around corporate credit. And, risk appetite is, I like to say, it's not on a dimmer, it's on or off. Just like you could price private credit at 100 one day and 0 the next. That tends to be the way risk appetite works. So if the market suddenly decided, this is now we're overvalued and we really need to, cool it, that would cause a massive reverse wealth effect that then would be a whole other, we'd be like 2007 all over again in terms of what that means for the economy and for monetary and fiscal policy.
Wow, that's interesting. Yeah, I mean, that's a whole angle too on the auto loans, that because if people are missing utility bills in auto loans today before student loan enforcement, I mean, how exactly do they absorb another $300 to $500 a month when interest starts compounding again?
Yeah, and only one person won that 900 some odd $900 million lottery ticket. So that one person will be able to do it, but everyone else is kind of SOL. Now, it comes down to getting employment growth going, and we'll see how that, what happens. Although I'm highly skeptical of the numbers, given what we just talked about earlier. But you're seeing layoff announcements from companies rather than massive hiring announcements. And I know there's tremendous hope around the AI CapEx, which has been material. But that too isn't without its own repercussions that aren't super great for the financial markets. And I don't know if they've figured that out yet. But, when you see all these companies rushing to raise capital to invest in AI, well, that creates even more competition for the federal government for financing these massive deficits. So we're trying to borrow a tremendous amount of money, but to finance our deficits and to finance our primacy in this AI race. But we are struggling to come up with the money to do it. Who exactly is going to finance all this stuff, absent some massive expansion of the Fed's balance sheet and a whole new round of mischief at 0%, shall we say?
I like. I'm going to use that, mischief at 0%. We'll give credit though. Of course, big fan of Jim Grant. Okay, well, let's close on gold. Obviously, here at Kitco, we got to talk about it sitting here around 4,000. It's not breaking out, but I mean, given everything we just discussed, this data fog, the credit rot, the refinancing wall, the consumer stress, I mean, shouldn't it be around 5,000? What are your thoughts? Are we just going to sit here and let this accumulate, just a nice safe trade?
Well, I'm a huge bull, so I think it should have been 5,000 several years ago. And I drank enough of my own Kool-Aid about the forthcoming monetary expansion, and I think the Fed's balance sheet will easily top $12 trillion in the next credit meltdown. Easily, probably more like 15 trillion. So take whatever I say with a grain of salt. But if that's my view, obviously I think gold could trade, way above 5,000 just to back our monetary base alone. To fully back it would be $22,000, I think, on the price of gold. Now, no one's suggesting they're going to do that, but it just gives you a sense as to how enormous the mountain of paper claims are relative to this very small pool of gold available to back it. If we ever need to, God forbid, to come up with a more hard money currency. And I think we may get to that point, mostly because it's not just the U.S. that's in this situation. No. It's not just our capital markets that have gotten mischief at 0% and our consumers who are stressed by having high interest rates and debt service. It's all of the developed world economies, all of our major world competition, Europe, Asia, UK, Japan, So whatever debasement we engage in, they're going to engage in just as rapidly, which is just even more reason to be looking to sort of prioritize hard assets over paper. So I think gold's move is just starting, and I kind of love the fact that people are just kind of dabbling their toe in based on chart patterns, but still don't fully believe the story. And that just makes me feel like it's got that much farther to go.
I lied. I'm going to ask you one more question because you did bring up there. I mean, you brought up the miners. You're obviously watching them at these prices. Some of them just huge cash flow. I mean, any miners that you're looking at, I mean, it wasn't always the sexy play, but it's had some great returns.
Yeah, well, I have to confess that I'm a big picture gal, and I barely spend a lot of time, looking at my own portfolio. I certainly am not going to sit here looking at individual companies because it's just not what I do. So I have an investment with a great manager who I rely on his expertise. And then I own some of the, just the GDX and the GDXJ to get positioned more broadly across the sector. But for specific ideas, I would hate to venture because that's not my bailiwick so much. So I'm sorry to cop out on that one.
It's all right, Steph. I guess that's
a bit of your audience. I'll resist commenting.
That's all right. That's all right. I mean, macro is in the name of your company, of course. Stephanie Pomboy joining us today from MacroMavens. You need to check out that newsletter too. Thanks for this. Lots of interesting data. We'll see how the week plays out. Any one thing that you're paying attention that maybe this whole script goes out the window?
Well, the one thing, this isn't related to the script going out the window, but the one thing I would offer to your audience that thinks this is all way too doom and gloomy and I'm missing out on, what could be a great boom in the markets surrounding this new revolutionary technology that is AI, I would say you can still position that and have a comfortable hard asset versus paper bet by just going long energy. If AI is the future, and I believe that it will be like, this may be an internet bubble, but like the internet bubble, the internet will be a thing. It's going to be transformational. I think the same about AI. You can buy energy stocks for nothing relative to these AI companies that are trading at nosebleed valuations. And you're basically making a levered bet on the future of AI because AI's future is only as good as the energy required to power it. And that energy is preciously scarce. So it's a great way, if you're worried about missing this great technology revolution by sitting in gold, you don't have to do that. Buy energy.
Yeah. Well said. Long energy. Trade the picks and the shovels. Okay. I appreciate this. Thanks, Steph. Thanks again. Appreciate it. Okay. Talk soon. I want to hear from you on this. When you see UBS fleeing for the U.S., utility bills spiking 10%, does that look like a soft landing to you? Are we walking into a credit event? Make sure you let me know in the comments below. I do read them, believe it or not. And if you want to know the truth about what the Fed's missing, make sure you're subscribed right here to Kitco News. I'm Jeremy Szafron. We'll see you next time.